Nvidia beats forecasts, but investors shrug, raising fresh doubts about whether the AI boom can keep powering the markets. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the key numbers and warnings driving the cautious reaction. Despite Nvidia losing steam, Asian equities keep climbing, with the Kospi powering to yet another record. But it is a mixed picture for regional chip stocks. South Korea's central bank lifts its growth and inflation forecast as it holds rates, pointing to sustained chip demand and property risks. Peter Kim of KB Financial Group joins us to discuss how Korea's AI-fueled rally could collide with a potential property clampdown and what that means for markets. And Qantas posts a record profit as new Airbus jets lift earnings, though its international unit slips on rising costs. CEO Vanessa Hudson joins us from Sydney to discuss what the results mean for the fleet overhaul and demand outlook. Nvidia's upbeat sales forecast topped lofty estimates, helping to soothe some tech stock jitters. But the reaction in Asia is looking mixed. Avril Hong has more on the market moves so far. And Avril, you know what? It's hard to please investors these days.
Yeah, even after beating those lofty expectations, right? So we are seeing, to your point, this mixed reaction in the Asia Pacific. The hopes were high that coming into today, maybe Nvidia would be able to help provide a fresh boost for some of these Asia chip makers. Not like they really needed it, right? We saw just a day ago, TSMC, SK Hynix, Samsung Electronics hitting these fresh records. But today, what seems a bit clearer is the extent in which you're seeing that mixed performance among them. Given the memory player and the dominance that SK Hynix and Samsung Electronics play, they could be the ones benefiting amid the memory crunch. So you're seeing the Kospi really piling on a day where Japanese chip makers are coming under pressure, as is TSMC. Let's flip the board and take a look at the positioning coming into today. If you take a look at the relative strength index, for example, on the TAIEX, it just shows you how overbought the market was. And of course, underpinning all this has been really the moves in TSMC, those fresh highs, even though we're seeing that reversal today. Flip the board again, putting things into further perspective for you when it comes to the Nvidia moves. You remember how the past couple of earnings releases have seen pretty muted moves on the stock market, on the stock specifically, but overnight we did see, after the earnings release, there was a pop, but quickly paired as the call progressed. Perhaps investors wanting to hear a bit more about how exactly they are going to reach this $500 billion in revenue from the Blackwell, the Rubin chips as well.
Avril, thank you so much for that. And what a performance from Nvidia. Let's get more details from Nvidia's results. Our Asia Tech correspondent Annabelle Julius joins us from Hong Kong. They are solid numbers, Belle, blockbuster numbers.
Mm-hmm. Yeah, that's right, Has. But I think it's been quite a recurrent theme, really, for Nvidia earnings over the past few quarters, that we go into the numbers, we're expecting Nvidia to essentially beat on expectations, and then investors are still disappointed, and that generally seems to come down to the loftiest of hopes on Wall Street. So this time around, for the first quarter sales outlooks, there were some projections for sales of up to $80 billion. Now, we didn't quite get to that point because, of course, the company said first quarter sales are going to be around $78 billion, and that was still ahead, as I said, of the consensus, which was for $72.8 billion. So, yeah, there was, I guess, some disappointment. I think Avril had a good point there around just what the stock has been doing in the past few quarters, because even going back to the fourth quarter, we really haven't seen any sort of sustained breakout with these broader concerns around the health of spending that we have on AI and the outlooks for the industry overall. So we've been in a really tight trading range. But yeah, you're just recapping the forecast there. Just to go through the fiscal fourth quarter as well, we saw revenue gaining 73%, so just over $68 billion. Profit per share was $1.62. Again, both of those ahead of estimates. And of course, really most of that coming down to the data center unit. It was interesting because actually, when you took a look at the gaming division, here you fell a little bit short. But of course, gaming is just really a very small part of the business today.
And Bell, of course, disappointment when it comes to the China market. It is a crucial market for Nvidia, but little progress so far.
Yeah, that's right. I mean, it's certainly not as crucial as it was, given that we haven't seen any real revenue from China for the past several quarters. But there were a lot of hopes, you could say, I guess, after we had the green light from Washington and on the H200 sales. What is interesting, and we actually got it in a separate filing, was that, yes, the company confirmed that they had the US license to ship small amounts of H200 chips to China. There is the question, though, of how Beijing plans to respond to this, and it seems like the company is still very much not clear on the decision that Beijing will take, because they said they still haven't generated any revenue from the H200 licensing program, and they're not making any assumptions around that either. Of course, in recent AMD figures, you did see some small revenue coming from the mainland market, but at the same time, it's not the most advanced technology. They were selling legacy technology instead, AMD, but Nvidia, still no sales into that market.
Belle, thank you so much for that. Great perspective there. Our Asia tech correspondent, Annabelle Drulis. Well, our next guest is a seasoned semiconductor expert with a deep focus on the global AI ecosystem. Let's get insights from Dan Heyler, senior analyst at EFM Asset Management. He's also managing a global AI-focused technology fund. Dan, good to have you with us. Put this Nvidia results in perspective for us. Lofty expectations, and still, despite the very strong numbers, not enough to soothe concerns.
Yeah. Hi there. Nice to see you again, Haslinda. So, yeah, absolutely. I think we've seen this pattern, as you indicated. Really, there's no track record of Nvidia really breaking out after any of the results, and that's just been the trend. The key thing, and I think the headwind that the market continues to grapple with, is to what extent actually the competition that is coming in. We continue to hear about TPUs and the integrated ecosystem of Google. Clearly, AMD is very aggressive with their custom solutions, and a little bit of I think the investments and the co-invest, and that has been a bit of a headwind. But I think as of the last 3 months, where I've gotten a little more positive on Nvidia, we've been very positive on the whole ecosystem as it relates to certainly TSMC and memory and networking. That's really been a huge performer relative to Nvidia. But right now, I think when we really start to see now the agentic announcements, particularly out of Anthropic and Cowork, finally this enterprise element. We've heard again and again about the CSP spending and even the continued upside in CSP spending, even the big upside in CSP and hyperscale, investing $700 billion now. Even that didn't really move Nvidia. So I didn't really expect the stock to move even on the phenomenal numbers, given the way it's acting. And I think what the market now will continue to kind of wait for is that visibility into 27. And it's really about token per watt, right? So they continue to get the huge performance in token per watt.
Dan, you say it is about competition. Is it not about CapEx as well? I mean, when will we see an easing of CapEx and also an increase in revenue?
Yeah, exactly. So that CapEx to sales number that I look at really closely, it's at all-time high. So CapEx at 38%, and the run rate has been about 15% CapEx to sales. So the question is, when can actually revenue accelerate such that CapEx to revenue starts to fall, and we see the monetization coming through on the CSPs? That's clearly that's one bucket, and that's also a headwind. I think what Jensen talked about is really 27, 28 that would kick in. We see it specifically with already, Meta's monetizing very fast. That revenue bit that kicks in is happening, and it will just accelerate with the CSPs, particularly in 27. But the big number, which is kind of getting to say that $3 trillion to $4 trillion market in 2030. The back of the envelope calculation says, software, run rate 300 to 400 billion was the run rate for CSPs. If you put 10 times on that, clearly that's capable, because it's agentic software. It's software that is responding real time and being generated. It's not software that just kind of being played back. And I think that's back of the calculation, we're going to get there, and Nvidia will clearly be the biggest piece of that.
Dan, And we know it is a challenging environment right now because there are lots of questions still being asked, but Nvidia is still, the biggest player out there. Can circumstances justify the valuations we're seeing in Nvidia right now? You take forward earnings or PE ratio, among the lowest out there versus its peers.
Precisely, yeah. So the share price, is up maybe 65% year on year. And earnings are up over 80%. So there's a derating that's taking place in the stock. Is again, it's about the rate of change on the out-year numbers. The market is clearly looking at 27, looking at monetization. I'm particularly positive about, just anecdotally, the startups that I'm hearing that are deploying AI and efficiencies. Anthropic with, capability, not only for knowledge workers, we're getting a lot smarter. I'm using it. It's getting better. You have to check it, right? But it's getting better every week as you look at Gemini and Grok and others. The second part of the big upside, again, enterprise is, administration, efficiencies, and then products. We haven't yet seen companies say we're generating products based on AI, and that's the revenue generator. When we start to hear more of that, where this is clearly just a revenue driver for a new economy and new capabilities, then the market will appreciate the value that that Jensen and Nvidia brings to the table. And remember, half of the business is still kind of just in the very nascent stage, and that's the networking and the sovereign AIs and enterprises. So that bit, they're spending really aggressively. Their software ecosystem is really the hidden gem. You can't just look at benchmarks of TPUs versus, Nvidia, Blackwell, or Vera Rubin. You really need to overlay that efficiency they're getting with the software as it results in much more efficient energy use.
How are you assessing the China market? We heard from Bell slightly earlier talking about how, we haven't quite seen the contribution from China, so it's not really that critical at this point in time. But if you take a look at a longer-term perspective, this is going to be a very important market for Nvidia.
Very important market and very important to China and China's economy, right? I mean, China was able to really transform its entire economy in the era of the smartphone. And that was mostly, foreign silicon initially. Huawei came in later. But had China restricted cell phone chips at that time, they would still be in the dark ages, right? So, and they were very good at software, customer interaction, e-commerce. They really led, I think, in some of the consumer applications of WeChat versus Facebook. So I think as we will see, I think companies definitely in China really want as many GPUs as they can get. My understanding, and I think on our checks, that they are capable of getting Blackwell in the markets and through different channels, and they have been able to. In fact, there's even spot market pricing on Nvidia GB200s. But I think it would be much better to get a full-on government kind of behind this, such that some of the state-run companies. For now, they're requiring, if you do buy Nvidia chips, you are kind of required to buy an equal amount from Huawei, and that's just not kind of that's not going to optimize the capability of China. So that's the big upside, I would say, in the future.
The market's still looking at, the possible winners and losers. We saw how that Citrini report sent, software stocks and the likes tumbling. And then we have Citadel providing some comfort. How are you weighing the two reports, and how are you looking at this debate?
Yeah, no, thanks. You have these occasional reports, that kind of come in and talk about this dystopian view of the world. Remember we saw the one about how AI runs out of control, and so these reports, we're in this era of everybody has a voice, and some of the voices are credible and some aren't. So that to me was a very, very weak argument as far as it relates to the capability of AI and how it plays out. The idea that this is going to lead to massive unemployment and a continued downward spiral for the global economy. And it's just there's really no evidence of that. You just need to look around your organizations, ask around people within your company how they're using, and talk to 20-year-olds. I mean, if you talk to a 50-year-old or a 60-year-old, we're scared. We don't understand. But remember, the people that built the internet were 20 years old, and I think. graduates are very excited. They're using AI tools aggressively in their job interviews and generating content. And you bring in that young entrepreneurial capability, technology savviness, just like the guys that used to be able to run spreadsheets for me, right? You bring that into an organization, it's going to transform organizations. It's going to generate new opportunities, massively reduce time to market, reduce operating costs, admin costs, legal costs, forums, and it's all playing out. And again, I encourage everyone to listen to the Anthropic YouTube that just came out about enterprise deployment. I think that is clearly a game changer.
What has been interesting, Dan, is that volatility has been seen among AI players in the U.S., but not really for those in Asia, the likes of those in Taiwan, in Japan, in Korea. It does seem like they've been, I guess, buffered from that volatility. Is that the way to go in the future? And what do you make of the rally we've seen so far?
Yeah, it's great. I remember your earlier comments about the divergence, going into results. Clearly, TSM has way outperformed Nvidia as we thought it would, and memory. And so there were a lot of data points in Asia on the build, and Rubin being very much on time. And you're adding a bunch of chips into that ecosystem, which go into TSMC. It's like six kind of key, very high performance chips. So I do agree, and I think that focus on the builders, where there's a lot of value is capable within even Taiwan and Korea. The big names for sure, but there are a lot of mid and small caps that are part of these ecosystems, within the CoWoS and the substrates, the interconnect. We're getting into co-packaged optics in 27 and 28 ecosystems. Because remember, as Jensen said many times, that these are full systems. That you can't just rely on Moore's law and shrinking die every year as we did in the PC era, right? So it's really about taking this entire system and taking data centers and cooling. It's about scaling the whole thing. That's how you get kind of 10 times performance at every generation. And Asia is the supplier. I mean, they're the arms for everyone, whether it's a TPU or a GPU or Nvidia or AMD. They're all here. And this is the best opportunity for Asia.
So, Dan, will software companies get decimated?
Well, sorry, which companies? Software
companies.
Yeah. So, yeah, great question. So, yes, if you do not have a proprietary data set, that proprietary data set is absolutely key for every company you look at, whether it's, you have medical or cancer capability data, you have client data, and in that sense, then, as you deploy AI on proprietary data and proprietary customers, then you're just going to get a lot smarter, faster, and better, and you're going to accelerate than everyone else. If you're an intermediary, like travel companies, where you really don't have much, and you're just, agentic AI is going to come in. But remember, I think there's a big misunderstanding between, say, like in security, there's security software which is needed to fight the outer world. AI agentic is not fighting the outer world security. Agentic AI within ecosystem is really working at the base layers of the technology and writing it. And so I think there's also a bit of throwing the baby out with the bathwater on the software names. You really do need to drill down into really specific company cases and where their value resides. And by the way, Anthropic kind of backed off a little bit on disruption, because a lot of those software companies are their clients. If you listen to their latest product rollout, they are clearly encouraging, and they're partners with with SAP. They're partners with Spotify.
Right.
And case by case.
Yeah, and we had Sequoia saying that AI is a lot of software. Dan, good to have you with us. Dan Heyler, Senior Analyst at EFM Asset Management. Still ahead, new tariffs, old trade gaps, and a push to rewrite the rules. U.S. Trade Representative Jamieson Greer explains President Trump's response to the Supreme Court ruling, striking down much of his signature policy. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. U.S. Trade Representative Jamieson Greer says President Trump will sign a directive raising his global tariff rate to 15% where appropriate. He told us it's a way to maintain continuity with countries that already have trade agreements.
Our goal with all of this is to have continuity. So we want to have the 10%, and we're looking about how to implement the 15% that the president indicated, because we want to have continuity. We want the countries, we want the companies, we want people to understand that what we were doing before, we're going to reconstruct with alternative tools, because we want to keep going, maintain the policy. We'll just have a change in the legal implementing authority.
So when you do raise the 122 tariff to 15%, what's your argument going to be to the Europeans? Because this is stacking on top of most favored nation rates. That means that for the Europeans that agreed on a 15%, the highest level they would agree to accept, this new rate for some products will be above 15%. What's going to be the argument to Brussels?
I've been in constant contact with my counterparts in Brussels, the UK, and elsewhere. And the way to think about this is every country has domestic procedures that they need to go through to come into compliance with the deal. With Brussels, we gave them a good rate on cars. That stays the same. With the UK, we gave them a quota on cars. We gave them a quota of beef to import duty-free. That stays the same. So a lot of these parts stay the same. But just like Brussels hasn't fully implemented its deal, or the UK hasn't fully implemented its deal, we also need a couple months now to have some domestic procedures, because the Supreme Court struck down all of this. It's pretty normal when you have a trade deal to implement over time. Most trade deals take years to implement. We're on the fast track, and so we're just going to have a couple, 3 months to make sure that we rejigger the tariffs in a way that comply with our end of the deal, and we expect the EU and the UK to hold up their end of the bargain too.
But Ambassador, in some of your comments, it seems like you're suggesting that the rate could go above 15%, and I just am curious what exactly you're planning to use. It's been discussed that Section 301 in particular will be used to go after places like China, which it has been used for before. Is that still in the cards?
Yes, so Section 301 is a country-specific tool, and it allows the president to investigate unfair trading practices by countries. And again, this is what we've been getting at over the past year. As we've concluded deals with over a dozen countries, they have agreed to eliminate unfair barriers to our trade, take down their tariffs, eliminate fake regulatory barriers, et cetera. And so we can actually conduct these investigations under Section 301 on a country-by-country basis, figure out exactly what they're doing that's been so problematic, and negotiate with those countries, but also impose a tariff as enforcement to make sure that they eliminate those practices.
Does the president feel constrained by USMCA?
So I wouldn't say feel constrained. We're in the middle of a review that we have to conduct in the United States. I'm in contact with my counterparts from both Mexico and Canada. There are things in USMCA that make sense, that don't get a lot of news because they function fine. But there are a lot of things where we don't have the type of market access we want, whether it's in goods or services. We have Mexico that historically, over the past few years, has been discriminating against U.S. energy producers and service providers. We have Canada that limits our access for dairy, has taken American wine and spirits off its shelves. So we have a lot of issues like that. We also have concerns about transshipment through Canada and Mexico of goods from third countries coming through and benefiting from duty-free treatment from USMCA. And so we want to make sure that if there's an agreement with either of these countries, that it really benefits these countries and not third countries that might use Canada or Mexico as an export hub into the United States.
Coming up, chip makers Samsung and SK Hynix are propping up Korea's market even as warning signals flash. Details just ahead. This is Bloomberg. Welcome back. You're watching Insight. South Korean markets are in focus today with its chip giants outperforming. Meantime, the country's central bank has left rates unchanged as expected and projects no moves for 6 months. Avril is back to break it down for us. Avril.
Yeah, we are seeing the BOK today leaving rates unchanged, and as you say, they don't project any move. So markets are dampening those concerns a little about a hike in the next 6 months, and this is coming along with upgraded growth inflation forecast. The BOK says this will give it time to monitor the risk. And the risk is a key operative word. But let's talk through some of the moves in the markets today first, because the chip rally, Samsung, SK, that has really been underpinning what you're seeing on the KOSPI. And the KOSDAQ is at the highest since the year 2000, not to be left behind. So it's worth also highlighting the policy reforms that have been fueling the return of South Korea markets. And to some, this is also quite remarkable, given this is happening without foreign investors really coming in a meaningful way for South Korean stocks. This is a lot to do with the retail investor or the retail army domestically. Highlighting as well, given the BOK signals, how the Korean won is now at the highest since October against the greenback. Now flip the board, because it's also worth noting amid the stock market surge in South Korea that it is kind of breaking with what you're seeing in real economic indicators, the real GDP in South Korea. And then it's not like these housing stability concerns have gone away. Indeed, that is exactly what the BOK governor has been highlighting. Those concerns persist, along with the FX volatility that now seem to also be influenced by what we're seeing globally. So all considerations, the extent in which this complicates things for the BOK will be a concern.
Avril, thank you so much for that. Let's get more with Peter Kim, Global Investment Strategist at KB Financial Group, a financial holding company with the largest customer base and branch network in Korea. Peter, good to have you with us. I mean, what do you make of this, I don't know, what do you call it, blistering, explosive, dizzying, rally in Korea?
For many months, we've been searching for the right word to describe this, and I've basically given up on the right wording for this. But I think for those who followed Korea for a long time, we've in the history of Korean stock market, we had these massive rallies where all investors, institutional, domestic, joins in, and in this case. I personally been looking at Korea for 30 years, and to have such a concentrated and polarized market rally based on two stocks, and the speed and the pace and intensity, I've never seen it.
Can that momentum continue? And is there risk? As you said, it is based on two stocks. There is concentration risk right there.
Absolutely, but I think one should remind ourselves that it is a very much a global trend. You had the Mag 7 in the U.S., you had TSMC taking a 50% of the market cap in Taiwan, Samsung and Hynix now around 40%. So that's not the worrying part. I think the worrying part is that the pace of the earnings upgrade and the intensity of it, whether the analysts are now overreaching. Ultimately, this year, I think a few months ago when I was on Bloomberg, I mentioned that 2026 is going to be a year where earnings and valuation will matter more, because last year is all about growth and expansion of multiples. This year, I think because of the uncertainties all around the world, as well as probably the concerns of the currency and the growth fears, I think the investors globally will veer towards valuation. And Korean stocks in semiconductor sector both have earnings momentum and still valuation discount to their global peers in Micron and TSMC.
So what do you do? Keep buying?
Well, we've already seen year to date, foreign investors in Korea have been selling those two stocks. It's really been the domestic investors. And I think it is very typical of the momentum-driven growth and trading mentality of the local investors really pushing this up. However, we have seen these type of cycles extend for a long time in Korea. And as I mentioned, I think in the short term, tactically, I don't think shorting the market, or especially those two stocks, would be a wise move. I think one should really veer to, once again, the momentum on the earnings upgrades. And ultimately, it's an AI call. If there are any signs of cutbacks on AI spending globally, then that's when I think the sentiment will hit those two stocks in Korea.
You talked about momentum and you talk about retail investors. Retail investors are expected to put in a record amount of money. They're pulling money from the property sector to put it into the stock market. How much momentum, how much more upside do you think potentially there is for the Kospi? I mean, it's already breached 6,000. Some say 8,000 is in sight.
That is a very much a structural trend rather than the cyclical one that we've been discussing thus far. The structural trend that I've been calling for many years ago is that Korean investors in households have way too much of their assets in property and world record low allocation in stocks. That asset allocation shift, I think, will go on for 10 years. So what's driving this momentum this time is not just the AI or the earnings upgrade. It's actually the fund flow that is coming from the locals, which is very unusual because normally a cycle like this is driven by global investors. So that's why I remain cautiously optimistic that this momentum will continue because of that tailwinds of that fund flow that we're seeing from South Korea.
How are you assessing the risk coming from retail investors? We know that the BOK is quite uncomfortable that, you know, South Koreans are putting their savings and a lot of money into the stock market.
Normally, you would expect the regulators and the government to try to put a break on this because, you know, we don't want any of these household assets or the retail investors being hurt from a correction when it does come. However, the Korean government, since the election win, have been very much behind pro-growth and pro-stock market. And I think that's been very well packaged alongside their market reform. So you have confluence of factors really aligning for extended run. And it just happens that the AI, a very powerful global theme, has been leading this charge. And it's just not been the two AI stocks either. So there's been few other sectors in Korea that has benefited from the market reform effort. So it really is a stars aligning. Again, normally I would be cautious about that correction that may loom, but I remain optimistic that we could have an extended run.
So you do see a further broadening of this rally?
One would hope that there would be a little bit of a breather along the way. I mean, you know, despite all these positives, a breather or a consolidation phase for the next run would be the most reassuring. But as you can see, you know, once the local investors have decided to get behind this, you know, a barely 1 or 2% correction is met by even greater buying. So, yeah, I mean, you know, we just have to watch very closely. But again, for me as an analyst, I'll be looking for any signs of a curbing of the AI capex spending globally that could really hit this momentum. But outside of that, I'm remaining very, very bullish.
We've been talking a lot about Samsung and SK Hynix when it comes to AI plays, but some also point to Toyota Motors, which is big on robotics. That could potentially be another company you should be looking at. How are you assessing that? And are we missing out on other potential AI plays in Korea?
So Hyundai is a different story because unlike Samsung and Hynix, it does not have that massive earnings upgrade. It's really been more on the very, very future forward-looking earnings that could one day come. So ironically, usually it's the tech sector that's more conceptual and the auto sector that's really sort of a little more grounded on fundamentals. But this time it's been reversed, which is very interesting. Hyundai, to its benefit, has done wonderful work on corporate governance, which is probably related to the market reform plans and the Commercial Act revision and other corporate governance efforts that Korean government has done. So I think if I was to choose between the two, I'd be a lot more cautious on Hyundai than Samsung, purely on the basis that it doesn't have the earnings momentum that we see on the tech sector.
How best to hedge Peter, I mean, surely there are risks out there, and we've seen how there's been so much volatility. How do you risk against all the moves that we're seeing in the Korean market?
So it depends on which risk you're talking about. If you're talking about a pure AI sector momentum waning, then obviously, you can just buy the index or the short the index against your semicon exposure. But that would not be Kospi index, by the way. It would be other indexes around the world because Kospi is so concentrated with the semicon. If you're talking about more of a geopolitical risk, then actually I would say that the Korean defense sector has been one of the key beneficiaries that done a lot of the re-rating last year that have not done so well because of all the concentration of fund flow going to semicon. So defense sector globally would be a very good hedge, and even for Korea. And I think those two hedging mechanisms would be ample enough for now. But again, I warn my hedge fund investors about shorting too aggressively against this very, very intense momentum.
Of course, when we talk about AI for months now, we've been talking about that debate, whether or not there is a bubble. Where do you weigh on that? And earlier you talked about how you're looking out for signals. What signals in particular should we be looking out for?
Yeah, so, everyone's talking about that $3 trillion global spending on AI. And I still have difficulty in understanding exactly what segments and sectors that's going into. But so far, you see the number that $600 million been pledged, or sorry, $600 billion been pledged, and about to go in this year. Now, I think the reason why I'm very positive on the semicon chip makers is that regardless of who wins in the AI race, because at some point, not all these hyperscalers will win. And that's why there is these worrying concerns of the AI sector. However, as long as these players are staying in the race to be the ultimate winner, the hardware makers, especially the chip makers, will win. So risk reward based on that earnings visibility is one that we need to hang on to, and that will put the chip makers in good stead.
And which hyperscalers will win?
I'm not smart enough to make a call on that yet. I do think that there are smarter people out there who's making a call on it. I think what's clear is that I'm old enough to understand that the TMT bubble, there are unexpected winners, and there are global winners, and there's the segment winners. And I'm not sure that we actually even understand which one of the hyperscalers fit into those three boxes: losers, winners, and segment winners. And I think when that happens, then maybe we'll get a better sense. But until we get a sense of who will be the loser, again, we can lean on the fact that the ones who will supply components and chips to those, hyperscaling, race to the ultimate winner race gives you the earnings visibility. So I think, a few months ago, I mentioned that risk reward is still with the chip makers. That's still the case today.
All right, chip makers, the way to go. Peter, thank you. Peter Kim, global investment strategist at KB Financial Group. Now, Baidu is set to post fourth quarter earnings on Thursday, under pressure to prove its AI investments are on track to paying off. The stock is down around 20% over the past month in Hong Kong as investors seek tangible results. For more, let's bring in Asia Equities reporter Charlotte Yang in Hong Kong. Charlotte, true to our conversation with Peter just earlier, they want tangible results. Show me the money and what's being done with it.
Exactly, like you said, given where we are in this AI trade, equity investors, they're looking for tangible results. And for Baidu, what that means is that they want to see, what they call the aging Chinese search leaders' AI efforts translate into a meaningful growth driver. And that has to be done quickly enough. So for the December quarter, the cloud business will be closely watched given it's tied to AI. And consensus estimates are expecting around 20% growth year over year. While that's positive, the overall all sales and profit are expected to fall because of the weakness in Baidu's core advertising business. So even though we are likely to see some, green shoots with cloud business, and also in some areas that could show Baidu's AI-led transition is starting to play out in user adoption of the AI products. But what investors really want to see is that they have an AI-led coherent growth story, so that they no longer have to worry about this persistent weakness in the core advertising business. So AI is one. Another area investors will closely watch is what the management will say when it comes to their cheap spin-off, the Kunlunxin. The news has boosted some sentiment earlier, but then that quickly faded. So traders wanted to hear management talk about the cheap spin-off IPO's progress, as well as its external sales, as well as its total addressable market, to help them assess how much value the spin-off could potentially unlock for the parent company.
Charlotte, China's AI space is a very crowded space, lots of big and good players. Is Baidu considered a must-have in your portfolio?
Exactly. Competition concerns is increasing. And for Baidu, I think that's twofold. For one, on the business side, as we just ended the Chinese New Year holiday break, a lot of these China's mega cap tech companies have been giving out subsidies to Chinese public to encourage them to use their chatbot-like models. And Baidu is part of that campaign. So that competition is creeping up. And Baidu, even though it was one of among China's companies that's earlier to introduce such models, they have been gradually losing the leadership. Once again, that first mover advantage. And another fold of the competition is more on the equity front, which we have this year. There has been more what they call pure AI play listings in Hong Kong. From large language model developers to those chip designers. That means a tech conglomerates like Baidu that still has concerns over its legacy business is not that attractive when you have those pure AI plays staging even more impressive gains. So I think the stake is higher for Baidu to deliver that, that they have that coherent AI growth story this quarter.
You got to wonder what would turn around the Baidu stock story, down about 9% in the past month, lagging behind its rivals. Anything you're hearing that could perhaps suggest a turnaround for the stock?
Yeah, so Baidu's trading, in the past years has struggled to break up this, I think, around 55 billion market cap, because usually short term they have some excitement about the AI efforts, whether that is with chip or with the robo taxi, but that usually that quickly faded out because investors goes back to concerns about the long-term earnings, which, back to what I said, I think it really has to show, if you want to win back investors long-term favor, you have to show that your core business is recovering, with the help of AI. But I mean, shorter term wise, there are a couple of catalysts people are watching. One is with the progress of the cheap spin-off, and also another thing is what Baidu will say when it comes to their shareholder return plans, and so those are the two near-term catalysts people are watching.
All right, and we're watching, of course, his earnings. Asia equities reporter Charlotte Yang there for us. Still to come, hear why a billionaire fan of Warren Buffett is sounding a warning on India's stock boom as it concentrates winnings in the hands of an elite few. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Let's do a check on Indian markets. We're seeing a bit of a reversal when it comes to Indian IT stocks, the likes of Infosys, Tata Consultancy. They're in slightly positive territory following the rout we saw recently. Of course, that has to do with Citrini research amplifying concerns about companies vulnerable to the growing influence of AI. We had the Nifty IT index tumbling to the lowest level since August 2023, but we're seeing quite a reversal today. Infosys now up about 1.5%. Now, staying with markets, and a long-standing India bull is now adopting a more cautious tone Ramdeo Agrawal chairs one of India's biggest brokerages in Motilal Oswal. He's warning that the stock market rally has only helped a handful of the nation's elite, and this will ultimately hold the economy back. For more, let's bring in Asia Equities editor Chiranjeevi Chakravorty. CJ, tell us more about what he said.
Yes, Ramdeo Agrawal, a billionaire, in his own right and owner of one of India's largest broking firms, he says that the stock market boom that India had seen over the past 5 years since the pandemic has largely been concentrated at the top end of the population, basically benefiting the top 5 to 7%. And a vast majority of the population have missed out on the wealth effect, that the top guys have enjoyed because of that boom. And he says that that wealth effect is sort of having impact on consumption because, according to him, consumption is driven by both wealth and income effect. He personally said that his own consumption sometimes is driven by his wealth rather than, the salary that he draws from his day job. And therefore, he feels that that is constraining, the Indian economy, where we well know that consumption has been an issue for regulators and policymakers, with, Prime Minister Narendra Modi last year providing relief on income tax as well as taxes on everyday consumption item. So that is his main thesis at this point of time, flicking at, the global theme about inequality that people have been talking about over the past 5 years.
And CJ, he highlighted in particular the earnings outlook for companies.
I think that is where he sort of flicked at that one of the reasons why foreign investors have been pulling out of India, and we know that they pulled out a record amount of money last year, is that earnings growth has been slowing down, largely because consumption has not fired up as much as one would hope for. And along with that, if you combine that with India's relatively expensive valuations within the Asian emerging economy space, that sort of makes India's case a lot weaker compared to peers in South Korea or even China, where earnings growth have been accelerating in a meaningful way, along with valuations being much cheaper than what India has to offer. And he feels that if this constraint on consumption continues, that will continue to weigh or cap earnings growth for corporates in India going ahead.
CJ, thank you so much for that. Bloomberg Asia Equities editor CJ Chakraborty there. Still ahead, BlackRock's Navin Saigal tells us why we may be entering a golden age for fixed income. Plus, we'll speak with Qantas CEO Vanessa Hudson after record first-half profit as the airline accelerates a major fleet overhaul. More to come in our next hour of insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The US dollar has come under further pressure in the Asian session, while in fixed income, traders are weighing tariff risks and the path for the Fed this year. Avril's back to tell us more. Avril.
Yeah, I mean, we have been seeing treasuries doing quite well in the past month, right? Given the AI disruption and the wobbles that has caused for riskier assets. But now you're seeing the 10-year yield approaching roughly the 4% handle, and that speaks to the sense I think investors want to see a bit more fresh catalysts. So maybe they're also looking at diversifiers, right? Other markets. You look at Japan, that's also been recovering since the January ruction. But then we have been seeing this week Takaichi's BOJ nominations. That's causing a bit of concern in the market. Then think about Australia as well, where you also see those higher yields. And then you have the likes of ANZ predicting a rate hike from the RBA for the month of May. So maybe there's more to come on higher yields. There's also the sense that Australia as a market is a bit less exposed to some of these AI wobbles. So that might be interesting as well when it comes to fixed income and opportunities. When you look at treasuries, you talked about how the Fed sounds patient and maybe that affects the shorter end of the curve. But long end, you still have, yes, the Supreme Court strike down, but back with these alternative levies, right? So there is a fair bit of uncertainty for bond investors. And, you have, for example, overnight, if you look at which part of the curve you should go to, the 5-year Treasury auction, slightly weaker demand. So it does speak to the sense of the bond market uncertainties as well. opportunities, but where exactly? I guess.
Yeah, and when it comes to the long end, that is the great concern there. Averill, stick around. The world's largest asset manager is forecasting what it calls a golden era for bonds, given by high yields and cooling inflation. BlackRock adds that bonds are poised to beat cash. Let's discuss this and more with Navin Saigal, head of global fixed income for Asia Pacific at BlackRock. Good to have you with us, Navin. I mean, golden age for fixed income, that's quite a big assertion. And you say it's mainly because of the broad opportunities, not just in treasuries, not just the U.S., but in other markets as well.
Exactly, and thanks for having me on the show, Haslinda. I'd say, we've been calling it a golden age of fixed income, but I'd say it's actually probably the golden age of investing. Whether you're in the US, Europe, Asia, whether you're looking at fixed income or equities, there is something to do. It's one of the most exciting times to be an investor, at least in my career. But in fixed income specifically, I think the golden age refers to this unique opportunity to build an income stream that's higher than it has been historically for much lower volatility. For a 6% income stream, which is pretty high by most people's standards, you only have to take about 2 to 3% volatility. You don't have to reach out the curve like you used to. There's been risks around the long end of the curve. And you don't have to reach down the credit quality spectrum. We've even seen jitters in the lower part of the credit spectrum lately. This is the unique opportunity that we think people should be locked in for the next 1 to 3 years.
You talk about the risk on the long end of the curve. We have the tariff wobbles. How do you see that shaking out at a time where defense spending, as Trump outlined in SOTU, that could also be another issue when we look into next year?
I think the fiscal trajectory in the U.S. is probably one of the biggest risks for fixed income investors, although that seems to have been more contained than what the worst fears were. 6% fiscal deficit indefinitely. We're seeing about $2 trillion of supply net per year, but that works out to about 500 to 600 billion of gross supply of treasuries per week. To put that in perspective, that is the size of the entire Australian government bond market. Imagine if Australia, or Singapore for that matter, tried to roll their entire government bond market every week. I think that's a part of the market that's vulnerable and that is underappreciated. But at the moment, there is demand for 3.5%.
But fiscal risk is a huge issue, right? And it's not just about the U.S., it's Japan and some other countries as well. If the U.S. can do it, so can we. And I think that is the general consensus among governments.
Yep, I think it's a valid concern. And that's why we think the optimal fixed income portfolio should not be oriented at the long end. Something like the front to belly of the curve offers ample yield with much less volatility than what we've seen at the long end. Japan, for example, last month yields at the long end blowing out. Those dislocations are actually, interestingly, opportunities to add. But I think, those are opportunistic trades rather than to build an entire portfolio around.
How are you seeing the extent in conviction among investors, though? Because there's this idea that for us to go big into JGBs, the BOJ needs to hike. And then now you have two nominees that look a bit dovish.
Well, I think there are parts of the JGB market that kind of balance all those factors. Yes, the front end is quite low in yield, and so that means the curve is steep. As you get longer, when you hedge those yields back to dollars, that actually fits nicely in a 6% yielding portfolio. You can get up to 3 to 4% on the JGB yield itself, and another 2% pickup in the FX hedge. But again, I think the longer you go out the duration spectrum, the smaller you can be in terms of size so that you can control for that volatility.
So this will be coming in spite of whether we see BOJ hikes, you think?
I think the BOJ hikes will help to flatten the curve. And so the long end is more resilient. That's anybody's guess.
What's your guess?
I think that the BOJ can probably continue on its hiking cycle, but it will want to be patient. Because Japan, let's face it, it has faced decades of deflation. It's just now coming out. When I was in Japan recently, I think people were genuinely surprised and curious about how to deal with inflation, looking at menu prices of their favorite restaurants where prices have changed for the first time in decades. Like this wage price, they call it a spiral, but really it's just a relationship. Wage price relationship is just starting to get going. The BOJ wants to ensure that it's properly nurtured. I think they are probably a little behind the curve and can afford to hike, but they are deliberately behind the curve. So, I think they may continue to ensure that this relationship holds.
Has it been surprising that JGBs have been pretty steady after that volatility in January? And are you confident such volatility that we saw will not return?
I think that kind of volatility is pretty unique, and actually we seize on that kind of volatility to buy dislocated assets. I'd be surprised if that degree of volatility returned, but at the end of the day, the underlying forces that created that haven't changed that much. I think many people are waiting for pensions, which are the main source of demand for long-end JGBs, to come back into the market. And on the supply side, people, I think, are waiting for some clarity around the fiscal program. But again, these are risks we've talked about. Yeah.
What about markets such as Australia? I mean, I was just mentioning earlier about how perhaps investors see it as likely a bit less affected by the AI concerns. Is that part of why you would dip into a market like that, given the yields at these levels?
Absolutely. So Australia is one of the few markets that's pricing in hikes. So let me just remind you, US is pricing in maybe 50 to 60 basis points of cuts. Australia pricing in 30, 40 basis points of hikes. So that's about a 100 basis point differential in the forward curves. That's a very attractive yield for fixed income investors. And the fact that we've now identified assets in the US, Japan, and Australia to go into roughly a 6% yielding portfolio, that just goes to show how attractive the global opportunity set is. So in Australia, if you add a little bit of spread, I'm talking high quality spread, investment grade, you end up back into that 6% yielding range, which I think is a very complementary.
Are there specific sectors you're looking at for Australia?
Well, in Australia, the banks tend to be the bulk of the credit market. But really, it's not just banks, but you're also counting on term premium. So it's the risk-free part of the curve that's also attractive. Government bonds.
Navin, we've been talking about the AI scare. Is that part of the reason why fixed income is the way to go? I mean, do you hedge in
So you
fixed income?
you call it the AI scare. I'll call it the AI economic transformation. And I think the market is trying to deal.
By the way.
I think the market is trying to deal with this economic transformation. It's pretty unprecedented, unless you go back to the times of the Industrial Revolution, where you've got, inflation, I'd say, was yesterday's news, and labor is tomorrow's problem. You've got a large-scale fiscal program. You're coming off the back of a large-scale fiscal program, and that's being met. That's been inflationary, and that's being met by, if you go back to Econ 101, labor is now less of a constraint to output. That's extremely disinflationary. So you're coming off an inflationary force, you're seeing a disinflationary force in the future, and I think the market is trying to grapple with how to weight those two things. And I think we're still underappreciating how disinflationary that transformation could be, as evidenced by the fact that forward curves are not pricing in much cuts.
We want to talk also about Fed policy. We are watching out for what happens in the back half when Walsh comes in, in May, when he takes over, right? But his intention seems to be a smaller balance sheet. What is that going to look like for the long end exactly?
So when you say smaller balance sheet, I think there are two ways to think about it. One is in absolute dollar terms. The other way is relative terms.
Okay.
I think the easier way to shrink the US balance sheet is relative to nominal GDP. You grow your way out of the debt. I think growth will continue to run pretty hot. 3% real, 3 to 4% real. We've had 2 quarters of 4% real, and about 2 to 3% inflation. That gets you to about 6% nominal growth. That's a pretty healthy nominal growth rate for the US.
So you talked about, I want to go back to what you said about this golden age where opportunities are broad. Europe, traditionally, the yields have been far lower than the US. Why is it as attractive as the US?
Well, inflation in Europe is running lower. So if you look at it on a real yield basis, the real yields in Europe aren't half bad. And I'd say that's true even in Asia. So that's why it's the golden age. It's a geographically diverse, it's a global opportunity set where real yields in aggregate and across the world are at about the 1 to 2% level, which is much higher than where they were just in the 2010s, when many real yields were deeply negative. Japan continues to be one of the standouts as having a negative real yield today, but the rest of the world is largely in this positive real yield territory. And real yields are the compensation or margin of safety for being wrong on inflation. So to be able to bake in this real yield buffer, and in Europe, if you swap it back to dollars, you get another 1 to 2% of pickup. That puts European assets squarely back into that 6% range, of which we use as building blocks for an income stream.
It sounds like there's a lot that you like out there. What do you not like?
I mean, the front end of Japan is still quite low yielding. And there are parts of the investment grade market, I'd say very high quality spread products, high quality investment grade, that spreads are very tight. So those, I'd say, are less attractive on a relative basis to pretty much any of the alternatives, whether it's cash, the treasury itself, or high yield, which has a bigger spread buffer.
Emerging markets, how are you looking at them?
Absolutely. I think emerging markets have pretty much a lot of things going for it. There's policy uncertainty on the developed market side. There's a cash rate in DMs that's been coming down, I think, for a long time. 2 to 3 years now, the US policy rate has acted as a magnet for cash. Money markets have been the biggest beneficiary. Now, as the cash rate starts to drop and has dropped 175 bips, expected to drop further, this is acting as a catalyst for cash to seek higher yielding investments. Some of those exist in emerging markets.
It sounds like really the perfect time to be buying into fixed income, yet people still talk about 60-40, 60-40. I mean, how do you reverse that? Why aren't people thinking about 60-40, fixed income to equities?
Well, I think the 60-40 mantra of old, the 40%, people tended to associate it with duration. Duration has failed to be a hedge for equities. And so some people have called for the death of 60-40. I don't think it's the death of 60-40. I just think you've got to think about your income allocation differently. People are still going to invest in stocks. That's the right place for someone who's young to invest in the capital stack. Stocks have done very well. The best complement for an equity portfolio today, we think, is a steady and strong income stream with not a lot of duration.
It's hard to think about steady income stream and 6% yields when you're in the stock market, you get double-digit growth. I think that is what people are grappling with.
So we've had 3 consecutive years of that double-digit growth, and that has also, I think, acted as a deterrent to fixed income flows to some extent. But from today's starting point, when you have stock valuations where they are, and the ability to still construct a 6% carrying portfolio with arguably 2% of price appreciation, that's an 8% total return. And I think the right question one should be asking is, if your starting point is 8% in fixed income, what do you require equities to do in order to allocate down the capital stack? That answer is probably 10 to 12%, and we may get 10 to 12%, but I think it's a really fascinating debate.
I think we also might want to touch on what we see in the credit wobbles. I mean, we've been seeing private credit, the AI concerns are reeling there, especially as investors grapple with the sort of software disruption that could affect industries. What is your sense of, is there any flow or ripple effect into fixed income?
I think if the problem worsens, there will be. But let me just put some perspective on private credit. Most estimates have the private credit market at about 1.5 to maybe 1.8 trillion. That's a third the size of Nvidia. Nvidia's market cap is 3 times of that. So it's like a 30% correction in Nvidia. That would be the size of the private credit market, or call it a 2 to 3% down day in the S&P. That would also be about 1.5 trillion. So when you put it in that perspective, the size of the private credit market doesn't seem systemic. Now, I'd also say that I think a lot of things are getting lumped in private credit that aren't necessarily private credit per se. I think there is a large space between public and private credit. In future, we may not even use the terms public and private. I think there's just going to be credit. And really, it's about how you are underwriting that credit, not so much about whether it's public or private, which is how it's being underwritten.
Fascinating discussion. Navin, Saigal of BlackRock and our very own Avril Hong. Meanwhile, Nvidia has failed to impress investors with its latest sales forecast, signaling that concerns about an overheated AI economy will continue to dog the company. Bloomberg's Ed Ludlow explains what's behind the market's hesitation.
Sales of $78 billion plus or minus 2% was a projection of confidence. And right now, Nvidia feels confident as well that it has the capacity and the inventory to meet demand going out several quarters. There have been questions about the imbalance between supply and demand, but in particular, to note that outlook for the April quarter does not factor in any sales, data center sales from China. What we learned in parallel in a regulatory filing is that the US government did grant Nvidia some licenses to ship H200s to specific China companies. but they're subject to review and a 25% tariff. And Nvidia said it doesn't know whether China will allow that, will accept the movement of those H200s into the country. Otherwise, you know, it was very much what we expected. Is the AI boom intact? And one of the ways that analysts put that to Jensen Huang was to ask if he sees the capital expenditures of the hyperscalers, which again in the quarter gone and presently account for more than 50% of sales, are growing, in particular when you take into account that their cash flows are being impacted. And the way that Jensen Huang answered it is, well, we see their cash flows growing because the tokens being generated on Nvidia compute platforms are profitable, and basically the software that's out there in the world right now is worth paying for. It's kind of a similar line of argument that Nvidia's made in prior years. The kind of unanswered questions, well, a deal with OpenAI, an investment in OpenAI is close, according to Jensen Huang, but in the 10K, they also disclosed that nothing's yet been finalized or determined. They put a lot of emphasis that the work with the frontier labs is deepening, and only Nvidia can do everything at every layer of the AI stack. We will wait to see in the back half of this year the transition from Blackwell-based systems to Rubin-based systems, Grace Blackwell to Vera Rubin, which, according to executives on the call, is very much on track. This is Ed Ludlow for Bloomberg News in San Francisco.
Still ahead, with Iran and the U.S. set to resume nuclear talks later in Geneva, we'll get you the latest on a ramp-up in U.S. sanctions and rhetoric. Keep it here with us. This is Bloomberg.
We are in negotiations with them. They want to make a deal, but we haven't heard those secret words. We will never have a nuclear weapon.
The negotiations tomorrow and the talks tomorrow will be largely focused on the nuclear program. And we hope progress can be made, because that's the president's preference, to make progress on the diplomatic front. But it's also important to remember that Iran refuses to talk about the ballistic missiles.
President Trump, during his State of the Union address, and Secretary of State Marco Rubio ramping up pressure on Iran ahead of a fresh round of nuclear negotiations scheduled for later Thursday in Geneva. Meanwhile, the Trump administration has imposed sanctions on more than 30 entities it says support Iranian oil and weapons sales. Let's bring in Horizon's Middle East and Africa anchor Jumana Basachi. And Jumana, it does seem like the U.S. is tightening the screws yet again.
That's right, with the news of the sanctions on those 30 entities, indeed. Even President Trump spoke about it in his State of the Union speech yesterday, saying that Iran wants to do a deal, but they don't seem to be saying, and this is a paraphrase, those magic words that they would never build a nuclear weapon. However, he has still said time and time again that his preferred method is to reach some form of a diplomatic solution. And indeed, today is perhaps a window of opportunity for us to see whether those diplomatic efforts can yield some fruits. So this is the third round of indirect negotiations that are taking place between Iran and the U.S. They're taking place in Geneva. The Iranian foreign minister was quoted before traveling to Geneva saying that they're looking for an equitable deal. However, the level of enrichment is going to be a key sticking point here. And if the U.S. continue to push for this maximalist approach of zero enrichment, all of the signals coming through from Iran have suggested that they would not be open to that they do want to allow for a low level of uranium enrichment that would allow for civilian use, the use of electricity, and possibly medical use as well. Now, this is where there continues to be daylight between the two sides. And the other element to think about, too, we just heard it from the Secretary of State, Marco Rubio, including their broader ballistic weapons arsenal as well. And yesterday, specifically, again, in the State of the Union, President Trump referenced the fact that Iran are building up significant capabilities in that space and the ability to send these ballistic missiles through intercontinentally, which would obviously be a big risk to the U.S. assets and the broader region. And so perhaps if they want to broaden the scope of discussion, they could apply more pressure on Iran on their ballistic weapons as well, in addition to the third point, which is their continual support of proxies around the region. Now, we've talked about the decimation of the top level of command of Hezbollah. We've talked about the change of the Assad regime, the diminishment of Hamas within the Gaza Strip. But at the same time, they still have these active proxies around the region, also in Iraq as well. There's a risk that should Iran choose to retaliate, they could fire up some of those proxies. Interesting that yesterday the Hezbollah chief was quoted as saying, or Hezbollah spokesman, I should say, not Naim Qassem, a spokesperson was saying that if the U.S. decide to go for a limited, quote-unquote, strike on Iran, they would not be incentivized to retaliate. But at the same time, Haslinda, tension's very high. We've spoken about the huge buildup of military assets in the region. The U.S. State Department is evacuating personnel from their embassy in Beirut. We're hearing of other nations also advising their citizens to leave some parts of the region too. So the next 24 to 48 hours really going to be crucial.
And even as we talk about those talks in Geneva on Thursday, Iran itself is preparing for a possible attack by the U.S.
That is absolutely correct. And if you listen to the language that's come out of them, so far it's been pretty defiant. They are saying that they want to get to a deal with the United States, but if there is an attack on their lands, they would be incentivized to fight back, but also to go beyond just a limited retaliation, which is what they did last year, of course, with those very symbolic or well-telegraphed strike on the Al Udeid base in Qatar, but actually go for something more harmful. Specifically targeting more assets in the region, again, firing up those proxies. There's always talk of that potential closure of the Strait of Hormuz. Though, of course, yesterday we were speaking about that with our colleague Ziad Dawood. That would be a bit of shooting themselves in the own foot because they continue to rely on the Strait of Hormuz for the export of their own oil.
Right.
And so, yes, there are a range of options being considered by Iran as well, Haslinda.
Bloomberg's anchor for Horizon Middle East and Africa, Jumana Basachi, thank you. Still to come, we get the outlook for Qantas after a record first half profit. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Qantas shares are under pressure today after earnings from its international unit unexpectedly fell. Avril is watching this for us. Of course, Avril, put that in perspective. It is actually a record profit.
Absolutely. First half record profit. For that perspective, it's worth noting that this was thanks in large part to its fleet revamp, and it was able to, replace some of these aging jets that are, of course, very, very thirsty. So that contributed to the record first half profits, and we initially saw Qantas's stock popping 4% at the open, but this is also quite remarkable, the fleet revamp that is ongoing, in that it has been, in large part, been able to receive its jets on time at a time where much of the industry is still facing these supply chain issues. We did eventually see Qantas's stock reversing, declining as much as 8+%, and this is against the backdrop of the carrier flagging these costs from wages, as well as some of these maintenance costs. Let's flip the board and take a look at this chart also that will show you the extent in which, for the most part, Qantas shares have been outperforming the broader gauge in Australia. Now, a couple of things that investors will also be watching out for, because we have been seeing reduced demands for its economy fares from Australia to the US. And then there's a key test for Qantas as well later this year when it receives its first jet of the A350s, that ultra long-range carrier.
Avril Hong, thank you. Let's now bring in Vanessa Hudson, CEO, Managing Director at Qantas Group. Vanessa, good to have you with us. First off, congratulations on the numbers, but your stocks are down about 9%. I'm just wondering whether you think you're being punished unfairly by the markets.
Well, look, we're actually really proud of the result that we've delivered today, not only because we saw earnings uplift, but we actually saw all of our metrics improve, customer, operational, and also we've been able to increase our dividend to our shareholders. And the one thing that we're really proud of is the Jetstar performance was a key standout for us, and I think this is the proof point that we've been saying for a long time, that these new aircraft, when they come in, when they get to scale, are transformative. They're transformative for the performance of the business, for our people, in terms of the environment that they work in, but our customers love it. So in terms of the performance today, I think we are looking through that in terms of what is going to come for not just further for Jetstar, because we'll see more of the new aircraft come for Jetstar, but we're also renewing our fleet in Qantas Domestic, and also we're going to see that start for Qantas International at the end of this year with the arrival of our ultra long range A350. So we're excited about what's to come.
The concern in the market is exactly the international routes. Some suggest that perhaps maybe you're unable to manage competition and costs on those international routes. How do you rebut that?
Well, no, I think what we're seeing on international is that we're seeing that there is a short-term impact on demand from Australia to the US. In the first half, I think as well, what we reflect on is that the Australian dollar was in the low 60s. That actually makes the US as a destination a very expensive destination. But we've actually seen the Aussie dollar appreciate significantly in the last couple of months, and it's now in the low 70s. So we actually think that this is going to be a good driver for demand. But the cost environment in international is something that we are very focused on. We are continuing to drive transformation. We've announced the opening of a Singapore crew base today, and we are going to see, with the new aircraft coming for Qantas International, we've actually said Sunrise is going to contribute to a material uplift in profitability, and having the right aircraft on the right route is an absolutely central part of what we see will transform the profitability of Qantas over time. And that's because these aircraft are going to give us what we believe is a competitive advantage. So the ultra-long-haul Sunrise aircraft that can fly from Sydney to London, from Sydney to New York direct, we are the only carrier that is going to be operating these aircraft, and that's going to enable us to fly over the midpoints. And we know that our customers are actually asking for this. We're seeing that these ultra-long-haul aircraft are performing really well now. Perth, London on the 789, Auckland to JFK, all doing really well. So this is what gives us the confidence that some of these short-term challenges will be overcome when the fleet renewal comes in and we see the step change that it's going to enable us in terms of performance for Qantas International.
Your aircraft has been crucial as you've laid it out for us. I'm just wondering how you're able to receive those aircraft deliveries when others are actually struggling to get theirs.
Well, I think the one thing that, if we wind back time a bit, Qantas Group was one of the first airlines out of COVID to undertake a global fleet tender. And it was a competition between both Boeing and also Airbus. And what that enabled us to do for both Jetstar, Qantas narrow-body, but also Qantas wide-body fleet renewal is that it enabled us to place the orders early and get in place slot positions for the delivery of those aircraft. And we work very, very closely with Airbus particularly, because a lot of the aircraft we're getting now are the narrow-body Airbus aircraft. And they understand how important it is for us, and we thank Airbus and the team, but we also are working really closely with Boeing as well. And so I think that's a key part of what is the strength in our order book, but also what is the strength in our relationship with the aircraft manufacturers.
How about your A380s? I'm wondering what you make of the economics of the A380s. These are thirsty planes. How much longer do you think you'll be flying these jets?
Well, the A380, first and foremost, our customers love the A380, and I think that is really important. We've gone through a refresh and a reconfiguration of our A380s where we've put the next generation business class seat on. And these aircraft are really important for us in the really big routes that we fly to the US, up through into London via Singapore, and they're doing really well across to South Africa. So the A380 is a critical part of our international fleet, and they are going to be here through to, the point where its useful life, would suggest that it should retire at around 20 years. So they're going to be a really important part of the fleet. But having said that, we are also getting the next generation aircraft coming, and that single engine wide body aircraft, which we know the engine technology is step changing again, both in terms of more efficient flying, so lower fuel burn, but actually those engines are enabling us to fly further. And we know for us, in terms of our distance in the world, as Australia being a long way away, that this next step change in technology is going to be such an advantage for us, because we are seeing our customers wanting more premium experiences. So these aircraft are coming with a higher density of premium seats. And we also know from the experience that we've had is that customers want to fly more directly, more point to point. And we can see the success of our Perth-London service, as I said, and also Auckland to JFK, that this is going to become a key part of our network and fleet strategy that will unlock what we see as this incredible experience for our customers.
Vanessa, we know that you've taken delivery of about 40 of the 200 aircraft on order. As you get more deliveries, do you think you'll be able to continue to provide higher dividends and buy back shares, or would that impinge your ability to do that because of the payments that need to be made?
Well, we've got a financial framework that we operate within. And I think really importantly, we actually set and spend our capital envelope that is in line with the earning production of our business. And if we look forward, in terms of what we've seen, these new aircraft deliver for Jetstar, we are very confident that earnings growth is in our future. And that is a really important part of generating higher cash flows that gives us the confidence that we've got the ability to afford the aircraft that we come. But we've also actually got a very strong balance sheet at Qantas. And we know that the combination of both gives us the confidence that not only can we renew the fleet, we can grow our earnings, but we can continue to reward shareholders along the way. And that's about striking the right balance, and that is an essential part of our financial framework and commitment to our shareholders.
We've been talking a lot about the impact of AI and the impact of AI on jobs in particular. And some are suggesting, Vanessa, that perhaps AI would mean a leaner management for airlines and also elimination of hundreds of jobs. How are you looking at the impact of AI on Qantas?
Well, first and foremost, digitisation, automation, AI, agentic AI are absolutely something that we are embracing. All organisations, particularly those in service industries, they have to do that to remain relevant for their customers, to continue to transform their cost base. And so we are adopting AI, have been doing that. We are seeing great progress in areas like revenue management, great outcomes for customers, particularly using AI to help recover better in a disruption. We're using it in our engineering and maintenance facilities through, using AI to identify points where we can predict where engine maintenance needs to occur. Both Jetstar and Qantas are using AI in our operational centres to deliver better operational outcomes and better safety outcomes. So AI basically unlocks value holistically for customers, better operational outcomes, better safety outcomes, and also better productivity and efficiency. And so what we see with AI is that I think that we're going to see a mixed change in our workforce. Just before Christmas, I announced a collaboration with the South Australian University and South Australian Government to invest in a digital service excellence hub, where up to 400 new jobs are going to be created that will actually help us accelerate using technology to get better outcomes. And so what I think that we are going to see that there are some jobs going to be impacted, and where there are, we're going to support those staff to be reskilled. But the one thing that's really important that I want to get a message across is that Qantas, given the investment in the new aircraft that we are making, we are going to see 8,500 aviation jobs created in Australia between now and 2030. Thousands of pilots, thousands of cabin crew, and also engineers. So we are going to be a net employer over the coming years because of the investment that we are making. That's great for our people because there's promotional opportunity, but that's also great for Australia because that's, an important part of what, drives our economy.
How about the impact of AI on cost? Do you see cost savings as a result of Qantas embracing AI? Is there any projections out there?
Yeah, look, absolutely. I mean, I made a couple of comments before about, the way in which we can use AI to better deliver outcomes for customers through our contact centres, smart way of handling customers in areas of disruption is really important. Waste reduction is a way in which we've been using AI to predict the consumption of food on flights, and so don't load too much or don't load too little. AI has been fantastic in actually helping us optimise our in-flight services cost. And so all of these use cases of AI, we are going to really drive hard, but also, procurement as a use case of reducing cost. We have thousands of suppliers in our database, and many of those contracts are complex, and so AI are helping us identify where there are incentives that we can claim, or rebates or refunds that we can claim, and so we're going to pursue all of those opportunities to reduce cost.
Vanessa, there are still a lot of ongoing issues within the industry, supply chains, for instance, aircraft delivery. Where are we with that? Are you confident that a lot of the issues will be resolved soon?
Yeah, look, I mean, I think that the aircraft manufacturers continue to flag that supply chains are still really tight. Both in terms of parts, maintenance facilities, and also engine availability. And I think the one thing that we are seeing anyway in terms of the delivery of aircraft to Qantas, they're pretty much arriving on time, which is great news for us because, we want to see these aircraft come in as quickly as possible. We are training our cabin crew and our pilots to be ready for when these aircraft come. And so, as I said before, working with Airbus as a partner, we are, feeling confident that they, understand, what is in their pipeline, and we're seeing the aircraft turn up, relatively on time, which is great news for us.
Might the issues affect your profitability going forward? Are there concerns about that?
Look, I think that, we understand and we work in a dynamic environment, and I think that we are confident in, Airbus delivering, but we are also confident in Airbus giving us early heads up if there is an issue. And I think that through this process, we have got to make sure that we are flexible, both in terms of the way we deploy the aircraft, but the way in which we ready the aircraft. And you've got to actually look through, the months or the weeks to the years that these aircraft are going to be within the group, 20 years. And that's what makes us so excited by what we're seeing in terms of the profitability that's being unlocked in Jetstar. We're actually excited to see those benefits flow for the Qantas Group, and that's about the years to come. And so the transition is important to make sure that we've got clarity and transparency of what's happening, but it's more about the delivery of these new aircraft over time.
Vanessa, the newsroom is abuzz with one question before we let you go. Is there any way you can confirm whether or not Bed Bunny did indeed charter an A380 from Qantas?
No, I'm sorry, I can't confirm that at all. We take the privacy of our customers really, really important for us. But I'm sure my daughters are going to enjoy watching his concerts when he's here in Australia.
Before we let you go, I mean, you've expressed so much optimism about the year ahead for Qantas. What's the biggest risk you see so far? Because there are already talk about a possible war, perhaps, between the U.S. and Iran, which could impact oil prices.
Look, I think I always say that the biggest risks are the ones that you can't control, and they are the impact of things, whether it be geopolitical, that impacts demand or impacts fuel. But, we are, an organisation that has managed through many of these cycles, and we are an adaptive and flexible organisation. We treat our aircraft as mobile assets. We will move them to where we see the demand is. We are absolutely focused on continuing to drive transformation so that we're as most efficient as possible. And we've also got risk management policies in place. We've got hedging programs in place. And so we feel really well set up for whatever might come that is outside of our control. We believe that we're in the best position that we've been in for a long time, with a strong balance sheet to be able to manage through anything like that.
Vanessa, such a pleasure to have you on the show. Thank you so much for your time today. Vanessa Hudson, CEO and Managing Director at Qantas Group. Still to come, our exclusive with the chief of Lotte Group's drug-making unit as they move to fill the gaps left by a shift in production away from China. Keep it here with us. This is Bloomberg. Lotte Biologics is betting on growth from a global shift in pharmaceutical production away from China. CEO James Buck told us exclusively that acquiring a facility in New York has positioned the company as an alternative for pharma firms looking to de-risk their supply chains. We have more from the Asia Trade co-anchor, Sherry An.
I'm here in Jamsil Central Seoul, home to Lotte Group's flagship assets. Its hotel, amusement park, shopping mall, cinema, they're all mainstay businesses for one of Korea's oldest and largest conglomerates. The group is now carrying out a major overhaul, betting on growth drivers and shedding underperforming assets. Lotte's chemical and retail businesses have been pressured by the global petrochemical downturn and sluggish domestic demand. Lotte Chemical posted another year in the red in 2025 with a $1.7 billion net loss. The conglomerate is now offloading non-core and overseas assets to shore up its balance sheet and pivot to growth. At its core, Lotte Biologics, with the group betting on its contract development and manufacturing business as a key future engine.
We're focusing on the CDMO because we have expertise in execution, and we have a history of a chemical division as well as customer-focused as well in hotel and retail business that we are well known for the last 50 years. So again, we could combine those technical and science with the customer-focused, and CDMO is the right area, and then the bio industry is also growing as well. So we feel it's the right area for focus for Lotte Group.
But because of that, there are so many other players as well, including domestically Samsung Biologics, Celltrion, and of course globally as well, as a new entrant. And you're very young, only 4 years, yes. 4 years, 2022 you launched.
Yes.
How do you compete?
That's a good question. We are late boomer, but I think one of the things that we could differentiate is we do have a BMS legacy facility that we purchased 3 years ago in Syracuse, New York, who has a rich history and heritage of a biological product manufacturing. So that's the differentiating factor. And then again, we cross-train from Syracuse as well as the Songdo facility that's coming online. So there's a tremendous opportunity for us to work together in cross-training and get ready for production in Songdo facility later on in 2027.
Are there any benefits to the supply chain realignment for Lotte Biologics, especially if you consider the likes of the new Biosecure Act that may hinder some of those Chinese competitors from the U.S. market?
Absolutely. We have seen a little bit of surge in terms of our candidate pool who may have used Chinese-based CDMO wanting to come to U.S. for U.S. manufacturing, mainly for clinical study in the U.S. It'll be easier from the registration perspective to have a clinical supplies manufactured in the U.S. for U.S. patients. So from that perspective, we're getting some traction. And also for the European pharmaceutical companies, again, because of this pressure, they want to have opportunity to manufacture in the U.S. as well for the U.S. patients. So definitely we're getting some positive attractions for our Syracuse site.
When you look at the customer demographics and across regions, are U.S. clients the most important at this point? Is that the most active part?
I think so. I mean, again, generally speaking, U.S. is the biggest market. So there's a lot of big pharma companies there. But certainly there is also, strong presence of Korean pharmaceutical companies as well.
Could eventually China market also be available?
I think so, but because of the current environment, I think that will be a little bit more challenging. But we're not going to ignore, because I think China has those areas where biosimilar development they're very quick on. So depending on availability in China CDMO versus what we could deliver from the Asia market as well as the rest of the world.
Well, before we go, here's a look at our lineup of guests for tomorrow. JP Morgan's Raisa Rassid will give us her market playbook with AI and geopolitical risks in focus. And we'll talk gold. Keep it here with us. This is Bloomberg.